So let's get this straight. Your parents, they bought their first home in 1995 for $180,000 on a single income with $5,000 of student debt. Today, that same home sells for $1.2 million. The down payment alone on a property like that is most likely going to be required to be 20%, which is $240,000, which is more than your parents paid for an entire house. Meanwhile, all the politicians are telling you that CMHC is going to help us build supply. Great news. It's only going to take 30 years, according to CMHC's very own research. Shows how uninformed most of these politicians are. 30 years. This is the housing crisis. This is a generational wealth transfer disguised as a public policy. And I'm about to show you exactly how the game works, why you're losing, and most importantly, how to win anyway, despite the fact that it doesn't seem like any politician has any understanding of what exactly is even going on or has any desire to change that. My feedback on this matter is that it's not a housing crisis. This is a system, basically designed to favor investors over families. And I'm about to show you exactly why and how it works, why you're losing, and most importantly, how to still win. Now, the idea of an investor itself is actually not a bad thing. But as it relates to our current system, it seems like now neither the investor nor the homeowner is going to win. But I'll show you exactly how in the next 25 minutes it could work and why we're in this current situation that we're in right now. My name is Alex McFadden. I run Flow Mortgage Company. I've helped over 5,000 families successfully achieve real estate financing on their homes and or businesses. And I believe I'm qualified to talk about this after doing this for 15 years and having seen multiple government legislations change and yet still not solve a single problem. But let's talk about what is going on and why this conversation was prompted. Let's start with the data that just came out in August of 2025. CMHC released their housing supply report, and the numbers are absolutely freaking devastating. Maybe shocking to a degree, but it is devastating. Canada needs, as you know, over 480,000 new homes built for a single year for the next decade just to restore the 2019 affordability levels. That means every single year, 480K for the next 10 years. We're currently sitting today at 90,767 units year to date. That is less than 19% of what we actually say that we need. But here's the part that should terrify you. CMHC's own research admits that even if we somehow hit these somewhat impossible targets, it will take up to 30 years for new supply to actually have any impact on relative affordability. I use relative affordability because, as we know, inflation goes up, wages go up, and so forth. But that's 30 years. If you are 25 today, you'll be 55 before the quote unquote supply solution the politicians are promising actually ends up working. Now, if you're 35, you'll be retiring retirement age, if that's still a thing in Canada at that point. Meanwhile, without the magical supply increase that the government is suggesting will happen, rents are projected to jump over 40% over the next decade, from $1,400 on average today to $1,900 by 2035, which actually those investors can take solace in that fact alone. The system is completely rigged against you. We know this. You're listening to this episode, you're not shocked. Now, I'm not going to say you should give up, but it's designed to basically keep people out because the numbers are dramatic and stark. And if you want to buy your first home today, let me just give you an example here. CMHC insurance caps a mortgage at $1.5 million. They allow a 25-year maximum mortgage unless you're a first-time home buyer or it's a brand new home. So if you're a first-time home buyer, brand new home, you can do 30 years. You're stress tested today still at 2% above the rate that you're actually getting. But here's the crazier part. A lot of banks use it based on the advertised rate and not the actual rate that you get because, as you can tell, they discount rates afterwards. You also need 5%, up to 5% down on the first 500 and 10% of the amount above $500,000 up to 1.5 million. You need 20% down on anything over $1.5 million. But here's what this actually means. For an $800,000 condo, you would need at least $165,000 of annual gross income, assuming you don't have any significant debts, plus at least a $55,000 down payment. And then depending which city you're in, you may have to pay transfer taxes, which could be $3,000, $5,000, $10,000, depending on your current circumstance. You have to have good credit, which is typically above 680 or 700, depending on the lender that you're working with. And then on top of that, obviously additional costs and a good or strong employment history. The kicker is that you're getting stress tested at 6+%, even though there's rates available for 4% today. You have to prove that you can make a monthly payment on a payment that's 35% higher than what you're actually going to make. Meanwhile, rental rates are going up. And on top of that, you're trying to figure out how to save for a down payment. And every year you wait, house prices, generally speaking, go up, although we've been in a little bit of a dip for the last couple of years. The system literally makes it harder to buy than it is to rent. And even though the truth is it builds equity and renting builds nothing. The amount of people I've spoken to who have literally been paying more in rent than they would pay for a mortgage, strata fees, and taxes, and heat, and other expenses is crazy. And they can't even qualify for a mortgage, which is absolutely nuts. Plus, I saw another stat that I'm going to share with you, which is that right now, CMHC is reporting that out of 100 units right now, 88 out of 100 multifamily units are being built as rentals, which is a complete flip flop from 10 years ago, where it was 12 out of 100. That is insane. And that comes back to the question of, is the agenda to push more rentals, and is Canada becoming a nation of rentals? Politicians, at the end of the day, they love talking about the three ways to fix housing affordability. Number one, increase household income. Number two, lower construction costs. Number three, extend amortizations. Now, I want to share with you why A and B, so number one and number two, are complete fantasy. You can't magically increase everyone's income without construction costs rising proportionally. And when wages go up, building costs go up, which is economics 101. It's a true fact that you cannot lower construction costs without eliminating the estimated 35% in taxes, fees, and regulatory costs that are built into every single home. But not a single politician is going to tell you which services they'll cut or which taxes they'll raise somewhere else to raise that revenue, which brings us back to number three, or option C, which was presented by a friend of mine in the industry. So I won't take credit to this, but it's something that people have talked about for a long time, which is longer amortizations. Now, I know what you're thinking, longer amortizations, more interest. But let's just talk about this. If this gets people into the housing market, you can artificially reduce the amortization schedule by increasing the monthly payment. And if people are paying more in rent right now than they are paying in mortgages, then what's the real problem here at the end of the day? Because rent is 100% interest. The solution is that one that actually could work mathematically, like longer amortizations, that is. And this is one that regular families just don't have access to. So here's a math: a $600,000 loan, 4% interest rate over 25 years is $3,161 per month. The same mortgage over 40 years drops to $2,389. Over 50 years, $2,089 per month. Now, again, that's adding 10 years to the life of your mortgage. So are we suggesting that you should do that? Maybe not, but $1,000 monthly difference is massive when you consider the difference between what investors can access and what families are actually stuck with. And before you say, again, 50 years is too long, how long are you planning to rent? And how long is it going to take for you to get into the housing market? That's the big question that you should be asking yourself right now. But here's what's actually going to happen with any meaningful housing policy changes. Nothing substantial, because anything less than a dramatic systemic change is just more of the same policies that basically created the mess that we're in today. And even if we implemented every possible solution tomorrow, 50-year amortizations for everyone, eliminated construction taxes, massively increased supply, that impact would take literally decades to take effect. Not overnight, not years, not months, literally decades. And CMHC's own research confirmed the same. They're suggesting as much as a 30-year timeline. So we are left with basically one option. We have to earn our way out, which basically means housing is a survival of the fittest, pure capitalism. And I don't like it just because I understand how to play the game. It doesn't mean it's actually fair or optimal. And I'm going to take a step back, because I don't necessarily think housing supply has to be fair or moral. We're not in a communist society after all, but there is an element of government intervention and control that has not fixed anything. And we've seen from history that the problems that they create are more than the solutions that they provide in virtually all situations. And where we are right now is a place where the ability to own a home comes down to one brutal question: can you out earn a system specifically designed to price out regular families? So, what does earning your way out actually look like with today's lending rules and market prices? So, first, some stats here. New math. In major markets, you're looking at about 800,000 to 1.2 million for a half decent property, which could mean a condo, a townhome, or maybe a small detached or semi-detached home. With CMHC's $1.5 million insurance cap, you need a household income of $140,000 to $200,000 literally just to qualify for anything in that range. And that's not a good job anymore. That is, typically speaking, two professional incomes or an exceptional individual earning power, which means someone would have to be far above the typical earning bracket on their own, or two above average incomes to be able to qualify for anything just to get into the marketplace. Now, the second thing that you need is multiple income streams. Typically speaking, employment income isn't enough. Even with good employment income, it's not good enough when you are against investors with business income, rental income, and leveraged equity from other potential situations or sources. Third, consider strategies that previous generations never actually needed in their situation. Number one, house hacking. Buy a duplex, live in one unit, rent out the other unit. There's duplexes with suites. You could rent out 3 units and live in one of them. Partnership. This has been a big one, and we've seen a lot of people consider partnership as it relates to getting into the housing market. Co-buying, joint venturing, buying with families, buying with friends, buying with someone you don't even know to get into the marketplace has given you access to better properties and maybe something that just suits you better long term. Market arbitrage, which is basically buying in secondary markets where your dollars will stretch further, even if it is for investment to get in the marketplace. And lastly, business ownership. Start a business. At the end of the day, the truth is this: starting a business doesn't necessarily mean that you make more money, but it gives you a higher and greater opportunity to capitalize on the income and money available in the marketplace. And although the banking system is designed to fail business owners, there are ways that someone who has a sizable income from a business can get ahead in a sooner time frame if they're able to quote unquote stack the cash and make more money or not rely on a typical hourly wage. The fourth one is basically, truthfully, just speed matters more than perfection. Every month that you spend getting ready to buy, prices typically rise faster than your ability to save, and the down payment target literally just keeps on moving. Now, here's what success in this market actually kind of demands if you want to be able to get into the Canadian housing market. And some people are going to laugh at this and suggest that it's bullshit that it even comes this. But the truth is, to get into most markets in Canada, you need a household income of at least $150,000 minimum, and not with a significant debt, but with some debt. Now, not eventually. I mean, right now. If you're not there yet, then that becomes your primary priority before even worrying about saving strategies. Now, I'm not going to say that someone couldn't get into a $400,000 condo or a $100,000 condo with a smaller income of 80, 90, or $100,000. But I'm talking about maybe a family home, that 800,000 to $1.2 million price point. You're probably going to need somewhere between 10, maybe 20% down payment saved, plus closing costs, plus 6 month reserves. For a $700,000 property, that's $140,000 in liquid cash, not even to have 20% down on a property. Again, I don't want this to sound dramatic, but this is kind of like ideal case situation if you're trying to get into something in that marketplace. You need good credit, you need a decent employment history, and you need to keep your total debt ratios under 44% of your gross income. Remember, we're using a stress test to figure out how you qualify. And the brutal reality is that if you cannot access these financial requirements in the next 2 to 3 years, you might be priced out permanently from that specific marketplace unless something changes. Now, I'm going to hold up and stop for a second. And here's where the opportunity comes in. 3 things. Number one, I just gave you a whole bunch of reasons why people could not buy in this marketplace. And a lot of this is pointed in the wrong direction. The truth is, there is a way in. Number one, buy a lower price point. If you're looking to get into the marketplace, you could buy something at a lower price point, like I mentioned earlier, and you can get in at a $400,000 or $450,000 or $550,000 price point for even 5 years or 7 years. Hold on to that property. You can use that to build equity and put yourself in a better financial situation. We already talked about buying with someone else. So if your income is 80 and theirs is 60 or vice versa, then your income amount can be a little bit higher. You could use the minimum down payment requirements, the 5% and the 10%, to get into the marketplace. And obviously, all is not lost if you are able to do so. But just keep in mind that you want to make sure to take care of your credit. And avoiding getting your credit looked at is not the way to do so. Make sure you have 2 credit lines and 2 sources of credit to make sure that you're paying that down on a regular basis. The truth is, the system is designed to fail, but part of the failing is not giving people the opportunity to understand how to get into the marketplace and the impact of the time waiting and renting, and how that will actually beat them up from a market perspective. I'm not suggesting that you should go buy a piece of real estate today, especially not if you're prepared. If you're not prepared, then definitely don't do so. But what I am saying is, if we look back at where our parents were 30 years ago, and you don't want to be the same person in 30 years from today, it might make a lot of sense to consider getting in sooner than later. And here's the thing. I wish I could end all this with good news about policy changes coming to save you, more supply, dropping prices, lower rates, impacting your affordability by some significant number. But the truth is, unless you're waiting for government incentives, you're probably going to be waiting decades at this point right now. And here's what you need to do. Number one, again, unless they're giving us an extended amortization period, you need to get serious about your earning power opportunities. This isn't about slightly working harder at your job. This is a fundamental shift. And it's crazy to say this at this day and time, but a 9 to 5 isn't going to cut it for the average Canadian trying to get into the housing market. And I've talked to a lot of people who feel the same way. And I'm not sitting here telling you that this is the right way. I'm telling you that this is, for a lot of people, the only way to get in there. You need to get strategic about market timing. Understand that waiting for perfect conditions or better conditions isn't the way in. Am I telling you right now, today is the best time for you? No, but I am saying the truth is that you, by waiting until somebody else does it, is probably not the best bet if home ownership is something that is important to you, because ultimately that just means, typically speaking, higher costs and more money spent wasted, other than the odd person who lives with their parents and is able to stack cash month over month and can wait and watch and see what happens. The truth is, most people wait until way too long to get any help and get any guidance. There are tons of tax incentive opportunities. There are tons of different ways that you can save money. And to be very specific, I would suggest that you should talk to someone on the mortgage side and the financial side to make sure that you're in the best situation, so that if you do buy a house, you don't absolutely go broke. Listen, whether it's the CMHC guidelines, the building, the amortization periods, or anything else, my feedback, short and sweet, is don't wait to get into the housing market. Now, if you're listening on the podcast or in the YouTube video, I'm going to put this in the comments for the First Time Homebuyer Masterclass, so that you can download that and get an idea of how to get into the marketplace. And if you want to schedule a free clarity call, there's going to be a link below to get inside my consultation calendar, so we can see where you're at today and how to get you closer to where you need to be. You shouldn't be waiting on the government to put you in the best situation for you.